Welcome everyone, I'm Matt Franklin, your portfolio coach, and this is the Portfolio Degree Power Hour. Over the course of the next hour, we hope to provide you with a basic introduction to investing, and we hope to help you learn how to more freely invest in the assets that you want. Our goal is to help you understand what the professionals on Wall Street know, and to give you a few methods where you can begin to deploy these strategies for yourself. I'm glad you're here. Stay tuned because we have some really cool stuff to share with you. Here are the topics we're going to cover. Got a lot to get through in a short amount of time, so please understand that most of this is intended as an introduction. If you'd like to learn more, be sure to check out our full training program. First off, I just want to say thank you for being here. Our goal with this training is to give you an overview of what investors are educated in order to build and maintain professional investment portfolios. Part of that is understanding how to select assets, and another part of that is portfolio management and being able to deploy these different trading strategies. While it's not everyone's favorite subject, we do want to touch on the math behind all of this so you can understand that these are not gimmicks and that there is something real going on in the background. We're also going to get into some basic of investment research and the things that you need to consider as you're doing your homework on the stocks you're interested in. Our goal with this hour is to help you avoid certain pitfalls and common misconceptions about investing while helping you learn how to actively manage your portfolio and gain that investment freedom that you're looking for. That said, I want to remind you that you came here for a reason. You had a goal in mind when you saw this training. When you signed up, you decided that you wanted to know more about managing your investments. And experience tells us that there's a particular goal that you have in mind. Maybe you want to manage your own portfolio. Maybe you want to learn how to build and manage wealth. Or maybe you're just ready to retire and you want to know how to avoid some of the pitfalls that might be coming at you. We're going to help you understand how to protect your nest egg and provide you with methods to continue to grow it for generations to come. No matter the reason you came here, we're glad you're here. We hope you're able to understand our methods and that this training makes sense to you. I really hope you leave here feeling more confident and better off than when you came in. And before we get started, I just want to reiterate the point that we're all better off when we work together and lift each other up. What we're trying to do here is not just build a training program and build some technology. We're trying to establish a community that helps to lift one another up, one that you can come to understand things better. So please help us make that a reality. If you're satisfied with the training program, please tell your family and friends. The more people around you that you can bounce ideas off of, the better off you'll be. And the more folks that purchase our training program, of course, the more we'll be able to expand it and can be able to continue to update our offerings. Ultimately, we hope you take away from this hour the ability to search for assets, to build a portfolio, and to manage it over time. We want you to understand the different strategies associated with each metric and how to deploy them. We also want you to understand how to balance risk. When you're talking to financial professionals, they will not want you to take on any unnecessary risk, so knowing how to navigate those conversations can be key. As you gain confidence and start to reach out to more investment professionals, the right ones will get excited when you explain to them what you're trying to do. And those are the traders you want to work with. Those are the folks that will have your back when you need them to, because most of them don't make any money off of stock trades. So if they're talking to you about them, it's because they like talking to you and because they think that the conversation is interesting and fun. Now, those are the folks that will always do their best to make sure that your portfolio is performing well. In an attempt to try and summarize what we're coaching here, I want to lay out the idea for you. First, you'll want to pick one of the different metric-based strategies that assigns our asset grades. And don't worry, we'll show you how the grades work and what's behind them. Then once you feel like you can properly search for assets, we're going to walk you through portfolio optimization and how to balance your portfolio between risky and risk-free investments. And then from there, it's all about checking the optimizer every few weeks to reassess and to determine if you want to change anything around in your portfolio. And then whenever you do go to make changes, whether that's buying more or selling off some of what you do have, or maybe it's just a rebalance to a new optimal portfolio using the same stocks, whatever your motivation, you always want to weigh your decisions with any potential tax implications. And that's one of the main reasons why it's always a good idea to consult with a financial professional before making any changes to your investments. At the core of this training program is our grading methodology, so let's cover that first. Essentially, what we're trying to do here is take complex statistical measurements and apply the results comparatively across the grading scale. The grading scale uses B- as an average. This method came about because I had a hard time understanding how to apply the statistics that they teach you in these courses to real-world decisions. Like, for example, I would analyze two stocks and get two different Sharpe measures. And we'll explain that metric a little more in a moment, but say one stock was a 0.34 and the other was a 0.51. Obviously, one number is a little higher than the other, but I wanted to know what that meant and how those numbers compared to other investments that are out there. Ultimately, was I making the best investment that I could, and how did it compare to other options that were available to me? So that's where a lot of this stems from. It was just a drive to translate all these statistics into something that was relatable. And after doing a lot of testing, I arrived at two grading concepts. One for stock grades, for comparing the performance of the different statistics across the total population of the investments. And the second is for portfolio grades, which are there to help identify where the risk is coming from in your portfolio. So let's take a closer look at each of those. Getting into the grading metrics, there were 11 different metrics that were originally tested. We're not getting into every single one of those, but we arrived at 5 that we felt best represented different investment strategies. Since some of those metrics are fairly common and others a little less so, we're going to walk you through them. As you can see here, these are the test results for the different metrics, starting at the top with expected return, then Sharpe's measure, Trainer's measure, alpha, and then our overall average. And from left to right, you'll see how they perform over the different historical time periods. We tested 6 different time periods: 90 days, 1 year, 5 years, 8 years, 10 years, and 15 years. We wanted to see exactly how these metrics performed when we used them to select our assets and to invest over a period of time. So we wanted to see if by changing the historical time period, if those things would make a difference. And as you can see here, there are certain metrics that across the board tend to perform well. And then there are others where you only want to pair them with certain historical time periods. Now, my favorite metric for stock selection is the Sharpe's measure, or Sharpe's ratio. And as you can see here, when you leverage that metric, you really want to use a 5 to 10 year history. You'll notice that alpha is another one where you only want to use a certain return time period. This time, though, you want to use short term, like 1 year or 90 days. So getting into the grading average, this is just an average of the stock's ranking for each of the other 4 metrics. We actually tested a variety of different mixes for this 5th metric, and the average of all the other metric rankings actually had the best overall performance. So we'll cover all these metrics in greater detail in our full training course in Portfolios 200 if you want to better understand the math behind them. The second letter grade is the portfolio grade. This grade is designed to help you identify the asset's contribution to the overall risk in your portfolio. As you can see in this example, for stock grades, one stock has a B+, and another has a C. When you combine them, however, what you might find is they don't interact all that well. And what that means is individually they might be a great choice, but when you combine them with the rest of your portfolio, they don't interact in the right way, and they're forcing you to take on unnecessary risk. So in working with the portfolio grade, A isn't always what you're striving for. You just want to use it as a point of reference. It shows you where the risk is. You don't want to eliminate risk from your portfolio because you do want some, because it's where your return comes from. But what the grade can help you do is compare fits and different combinations in an effort to identify the right stocks for your portfolio. Like, for example, you may want to include a hotel stock in your portfolio, but as you go to add the company you thought you wanted to invest in, you find out that it doesn't interact well with your other investments. So what you do, or what you might try to do, is compare a few companies in that industry, and you may end up finding one that actually works out really well with the assets that you already have, and it's possible that that's not the original asset you were considering. So think of leveraging these grades as a way to help you narrow down your choices and find the right investments for you. A lot of times I'll use portfolio grades and start with maybe like 20 stocks initially, then review the grades and narrow it down to the best 12 or the best 8 or whatever that quantity goal is. that I have in mind. And really, to me, that's the fun part of building your portfolio, is narrowing down your choices. In terms of how the portfolio grades actually work, they are based on the covariances of the assets. So here's an example of each asset's covariance graphed across the distribution curve. We take the highest and the lowest result, then scale the rest based on the grading curve. This allows you to have that frame of reference when you're trying to determine what's contributing the risk to your portfolio. So you'll always have an A and you'll always have an R, and all the other assets in your portfolio will fall along that distribution curve. And again, that's just there as a point of reference to help you understand where the risk is coming from in your portfolio. Once you have your stocks compiled, what's next? How do you know how much you want to invest in each one? That's where this concept of portfolio optimization comes in. Finding the optimal portfolio is an important part of how professionals decide how to arrange their portfolios. What you need to understand is that optimization, it does mean something mathematically, and we do explore the specifics of that in our Portfolios 200 lesson, but essentially what that means is that you take the assets that you want in your portfolio and then you test a whole bunch of different combinations and see which combination produces the highest return for the lowest amount of risk. Optimizers will then show you that set of weights from that optimal portfolio, and those are the weights that you want to use when making your investment, since out of all the potential combinations, that is the one that performed the best. In this example here, we do have another letter grade associated with the optimal portfolio. This letter grade is associated with where the portfolio's Sharpe measure falls within the overall population of stock Sharpe measures. And this is just done to give you an idea of what kind of investment you built in comparison to what's available on the market. Here's an example of what it looks like when you take those random portfolio combinations and graph them. By making the vertical axis expected return and the horizontal axis risk, or your variance, you end up with a curve that looks like this. As you can see on the right, the optimizer created 5,000 random portfolio combinations. If you take the portfolios and draw a line from the risk-free rate from where it would intersect the y-axis to each of the portfolios, the portfolio with a positive slope, the portfolios with a positive slope are the blue group and referred to as the efficient set. Then that line that you're drawing is called the capital allocation line. So the green portion is just where the capital allocation line's slope turns positive. Out of that set of portfolios, the portfolio that has the most return for each unit of risk, which you can see here, is referred to as the optimal portfolio. Another way to think about it is it's the portfolio with the highest slope on the capital allocation line, which is what you see on the graph here. The green dot is the portfolio with the gold line representing the capital allocation line going from the risk-free rate to the portfolio. The weights used for that portfolio are then recommended as the optimal portfolio. And here in the upper right, you can see the recommended portfolio weights. Then in the lower right area, here's an example of how to take your optimal portfolio weights and then determine how many shares of each stock to buy. When managing your portfolio, it's more than just making the initial investment. It's also about keeping up with it over time and knowing how much energy to put into that. Depending on your strategy, you might be surprised to learn that you only need to rebalance your portfolio a few times a year. We'll cover that more in a little bit. Here's an example of rebalancing your portfolio. You can see the portfolio from the previous slide on the left here. Then in the middle blue section, you'll see that a few weeks have passed by and prices have changed. The current value of your investments is shown, along with a comparison to what your portfolio should look like with its current value and your original optimal portfolio. However, before rebalancing it, you'll want to check the optimizer to see if there's a new optimal portfolio. If so, you should consider moving to that. And in a little bit, we'll talk more about the strategies behind each of the asset selection metrics and how our research says to manage rebalancing with each. Believe it or not, the strategies do actually change based on the metric that you're using for asset analysis. So be sure to stick around and learn more about how to leverage each of those. So, and speaking of asset analysis, where are all these methods coming from? A lot of these are academic methods that are studied and taught in universities. These methods are common, but we wanted to actually test what was taught to see what really worked. And in order to do that, we created a computer system that can analyze all of the stocks on the New York Stock Exchange and the NASDAQ. From there, we created an automated portfolio construction method that helps us bring our testing process together. We began by testing a variety of questions and claims over a time period from 2008 until March of 2020. And initially, we optimized our portfolios 4 times a year and built a separate portfolio for each of the different metrics. We then tested the grades to see which ones performed the best at identifying assets to include in our automated portfolios. And then those test results became the foundation for much of what we're talking you through now. Many of the academic claims about portfolio management we actually feel were validated by our testing, which makes sense. So we'll get into what those are, and we did see some interesting results that we're looking forward to sharing with you. The results of the testing, we'll cover with you in a few minutes when we get more into portfolio strategy. In terms of fundamental metrics, we have 5 foundational measures that we leverage for grading assets in our system. Like we said a moment ago, we use expected return, alpha, Sharpe's measure, Trainer's measure, and then we have an overall grade, which is just an average of the rankings of the other 4 metrics. When we started down this path, we weren't sure what would work for this. We chose these 5 because they perform the best over time, and some of them, you might even know or have some prior familiarity with. The results of the test you can see here. We covered this table a moment ago. And then in order to understand these foundational metrics, there are some other elements that you need to understand as well. In our full training program, we walk you through all of these metrics and the math behind how each of them work. But today we just want you to be aware that they're out there. This next chart shows the average return for each metric across the time periods from our testing. So looking here, if you've, on the left, you've got the S&P 500 return, then the annual returns for expected return, Sharpe's measure, Trainer's measure, alpha, and the overall average. Now, many of you might look at this chart and think, why would you ever choose anything other than expected return or Trainer's measure? And the reason why you wouldn't do that has a lot to do with beta, and we'll get more into that in a moment. The short version of the story is that you need to consider that the portfolio's asset selector is a computer, and it will make choices that most of us would not. Our first attempt at this resulted in some very questionable selections that did get quite lucky, but showed fairly dramatic variability. So as we adjusted our methods to take beta into consideration, we found that the returns became a lot more believable, and the tools were also selecting assets that we felt most of us would also consider. So being able to stomach a portfolio with a high beta, believe me, that's not necessarily a badge of honor that you want. And like I said, Sharpe's measure is my favorite metric to use. It's just a very stable, consistent, and reliable metric for identifying good long-term investments. That said, each metric can offer advantages depending on the market and your timing. We'll talk more about market timing later on, along with what you need to consider when determining your strategy for each of the metrics. Taking a closer look at historical time periods, you might say, well, why are you looking at 6 different time periods? And part of that goes back to me just asking a lot of questions and looking at a lot of the data that's out there, and specifically some of the stuff that's published by others. And when I was trying to validate the math in our system, we found that a lot of the mainstream sites actually use 5-year histories for their metrics, which if you look at the returns, that may or may not be a good way to look at the metrics, when you're using them for stock selection. So what we found as we were working through this was that depending on the metric, the historical time period mattered and should really be considered when developing your strategy for asset selection. And then overall, just in terms of just averages, we did find that for the metrics we included, that on average, the best performing historical time period is 10 years. So when you use our technology, you'll find that that's our default. Now, 10 years of history should work well for most measures, but depending on your strategy, again, you may want to make some different selections. Okay, beta. So a few moments ago, I mentioned that you may be interested in why expected return or trainer's measure might lead you down a path with a strategy that's a little bit more difficult to stomach. Essentially, what you need to understand is that for a lot of assets that have a high expected return and a high trainer's measure, that they're going to move a lot with the market. And beta is the measurement that will help you understand by how much. So if we look at this chart on the left here, this black line would represent an index like the S&P 500. So this is how that particular index would be moving over the course of this week. Then what you can see here is if you have a beta of 1, you have the orange line. So you can't even see the orange line because it's hidden behind the black line, which is essentially the concept of a beta of 1, meaning that the stock is essentially moving proportionately to the index. Now, it's true that it won't look like this chart. Not every day will every move be aligned, but over time, the movements are proportional to the index. So if you're looking at a stock with a beta of 2, for every gain or loss in the market, the gain or loss for that stock is essentially multiplied by a factor of 2. So what you're seeing with some of these assets that the computer selected, for example, was assets with a beta of 4 or 5, or in some cases even higher. So you can just imagine if the market loses 2% in a day and you've got a beta of 5, well, you just lost 10%. Now, you could have gained 10% as well, but that's what I'm getting at about the volatility that beta can help you identify. You really need to know how that works, because if you select a whole bunch of stocks that have betas of 2, 3, 4, 5, or even higher, then what you're going to have is a highly volatile portfolio where you could gain or lose 10, 20, or even 30% in a day. And I don't know about you, but most people can't handle that kind of stress. So what you're looking for in your goal with beta should be to find assets that are close to or near 1. And if you do that, that will provide you with a portfolio that moves a lot more like an index fund, which ultimately, when building your own portfolio, should be your goal. Now, getting into portfolio construction. So, what are we talking about when we even say portfolio construction? Well, we wanted to look into things like portfolio size, meaning how many assets you should include in your portfolio. We wanted to get into researching indexes for optimization, indexes like the S&P 500 or the Dow Jones Industrial Average, essentially to understand if changing that made any difference. And then we got into things like the optimization rate and tried to figure out how frequently you should rebalance your portfolio. And in our testing, we optimized the portfolios. In our initial testing, we optimized the portfolios quarterly or 4 times a year from those initial results that you saw. So for this next step, we created a new method that was set up to test how often you should actually rebalance your portfolio. There are some academics that do talk about this and make recommendations, and that was sort of the original inspiration for testing some of these questions. So we'll show you what we did, and in my opinion, the results make a lot of sense. The first thing we got into was portfolio size, or the number of assets that you should include in your portfolio. We tested quantities of 5, 8, 12, 20, and 30. And we did that so we could see a variety of different sizes to see if that would make a difference. When choosing the number of stocks in your portfolio, you should consider the amount of time that you want to spend on research. So, if you think about it, a portfolio with 30 stocks has a large workload that comes with it, and you might only have the time for a portfolio with 5 stocks. And you need to understand that's okay. When you've only got a few, you might think that it's actually more risky, but depending on your strategy, and we'll show you this, it might actually be preferred. What we found was that on average, the best performing portfolios tended to be in the middle. For certain metrics, it did say some quantities perform better than others, but on average, it showed that our portfolio with 12 assets included overall performed the best. Now, that said, when you look at each of the individual metrics, you find that certain quantities of assets tend to work a little bit better than others. Earlier, I mentioned that I like using Sharpe's measure. For me, to get the best possible return, I should go with a portfolio that actually contains 8 assets. Now, I could go with a portfolio that contains 12 or maybe even 30 if I feel like it. Those portfolios did outperform the market, but why would I want to keep up with more if I can get a better return with just 8 or maybe 12. So, which in that range is also what the academics preach is ideal. It seems like for most metrics, you should include anywhere from about 8 to 12 stocks in your portfolio. But if you want, you can include anywhere from 15 to 20. Anything beyond that, unless you're a fund manager where it's your job to keep up with everything, all you're likely doing is giving yourself a whole lot of hassle for not much more return. And, the point of a lot of this training is to show you how to work smarter and not harder. In terms of testing the index, there were 3 measures that we leverage in testing that could make a difference by changing the index, and that was alpha, trainer's measure, and the overall average. So those are the measures that we tested here. We changed the index between the Dow Jones Industrial Average and the S&P 500, as well as the NASDAQ Composite and the New York Stock Exchange Composite, just in an effort to see what sort of differences that would make. Now you might be asking me, why does that even matter to change the index? Well, index selections matter because when you're building stock returns, it makes it into your covariance, and that will impact your beta, your alpha, and your trainer's measure, as well as your R squared. And if you're using alpha or trainer's measure or the overall average for stock selection, it will make a difference in the asset grades. So if we, take you through the math here, starting with expected return from the index, it flows into the covariance down here in the purple box. And from there, your covariance flows into your beta as well as your R squared. And then your beta flows into your alpha and your trainer's measure. So as you can see, by changing that index, it can have an impact on your stock grades. And what we wanted to see was, did it make enough of an impact to consider being able to change that when building your strategy? And really, taking a look at the results, there's really not a noticeable difference between them. The best performing in terms of the highest average were the New York Stock Exchange Composite and the S&P 500. However, the median was the Dow Jones Industrial Average. So each of them, for at least one of the time periods, did rank as the number 1 index. We leave the default in our reporting as the S&P 500. That's the red line on this chart, which just gives you a pretty good return and really the best return for several time periods. If you want to see stock metrics based on different indexes, you'll probably have a hard time finding data like that unless you create it yourself. In the end, there's not really much of an advantage to doing it. So, what's the point of going through all that hassle? Our computer system can do it, but right now we're just using the reporting based on the S&P 500. Okay, now probably the topic you're most interested in and will remember after this lesson is portfolio optimization. So as you can see here, we went back and revisited our portfolio construction method to come up with a new method that took beta into consideration. In these returns, you don't see quite the dramatic swings that you saw in the initial studies, but nevertheless, it does paint a clear picture of which metrics outperform, which optimization time periods outperform the S&P 500. What we found was that from about 2 weeks out to about 8 weeks, that's where most of the value creation is in your portfolio. If you hold on to your assets a little bit longer, certainly it's understood, if you have some dividend paying stocks where you don't feel like you have a need to check them as frequently, but ultimately you want to revisit your optimal portfolio and rebalance at least twice a year. So if you're checking it weekly because you're thinking you're going to get some hot tip or some type of like lottery win type idea, really what you're doing is you're extending yourself and you're putting in energy way beyond what's required. And, I'm sure you have much better things to focus on. So in reality, you only need to check your optimal portfolio and potentially rebalance about every 2 to 8 weeks. Or an easier way to think about that is really about once a month. So if you think about rebalancing your portfolio 12 times a year, that's not so cumbersome. And doing research to do that doesn't take up a whole lot of your time. I mean, come on. Some of you spend more time on your fantasy football lineups or listening to the latest celebrity gossip or conspiracy theory. I know I'm guilty of that sometimes, so I bet you occasionally are too. So, just try to focus on what's important and ignore the rest and only put in the energy here that's required. Market timing generally is used when referring to people that are trying to time stock pricing with the market, meaning to buy when stocks are at their lows and sell when they're at their highs. The problem with that is that's very hard to do, and there's generally a lot of stress associated with trying to get it right. Plus, when all is said and done, sometimes you miss out on those moments of unexpected return, when the market did the opposite of what you thought it would. What we're getting at is that some of these metrics, depending on what's going on during that year, will perform better than others. So when you see a growth year, there are some metrics that might perform a little better in terms of helping you identify the right stocks to pick. So overall, you can see that each metric did have years where when it performed at its best, and some metrics do tend to fit certain market outcomes better than others. Now, we can't predict what the market is going to do, but if we show you what has worked in the past and what is working, that will give you an idea of how to plan your strategy and what metrics to use when selecting stocks for your portfolio. We're not going to offer you predictions for how we think the market is going to perform. That's very difficult to do. Plus, there are a lot of great professionals out there that you can talk to, as well as others online where you can listen to their podcast or subscribe to their channels. People who monitor those sorts of things more closely, they can give you a better understanding of how they feel the market is going to perform and what to expect. We're just here to coach you on how to manage your portfolio, while showing you what's worked. So that way you're better prepared when setting your strategy and building your initial portfolios. So in terms of the studies we did, we have a technical research overview where we go through all of the research and the testing in more depth. We put pretty much most of the results in this deck, so you have the majority of the important pieces of information. But if you're interested in learning more about our methods, we include that with our full training program. Our intention with that study is to update it annually. So if you see, so that way you can see what's working and then adjust your strategy if you need to. That said, when you combine everything that we've tested, what do the results say? So starting in the upper left corner, you can see how many stocks you should select. You can see for expected return that actually having fewer stocks in your portfolio performs better than the other options. When you have a few of them, if you think about stock selection with expected return, it's just based on stock price growth and who's performing well. And if you have a couple of them performing well, the more your portfolio is diversified, the less risk you're taking on, and the more balanced your return will become. So in terms of the optimization rate and how frequently you should optimize it, here on the left side, on the right side, you can see that bi-monthly and semi-annual are the ones that really jump out here. So really that means that about every 2 months or almost every 6 months at most, you should check the optimizer to see if anything has changed and then rebalance if necessary. Then in terms of the historical time period for calculating your return, you can see that the return continues to go up as the amount of historical data increases. So by the time you get to about a 10 to 15 year range of history where the stock is one of the top performing over that time period, what it's doing is it's showing you the best of the best in terms of price performance. And then in the last chart that we have included here is the metrics performance over time. You can see the performance by year in comparison to the S&P 500. So just something else to consider. We do talk about, market timing as we go through this, and market timing, again, we just mentioned it, but in our opinion, it's just making sure that you have the right strategy for the current market conditions. And one thing I would like to note with this chart here is just that the 2020 return on this chart was just through March of that year, which primarily reflects the COVID downturn. So that last year can be a little misleading. Our focus the past few years has been on launching this program, but we are planning on publishing research reviews at least once a year. In terms of alpha, you can see you want to have about 8 to 12 stocks in your portfolio. The historical time period should be a little bit shorter. 90 days to 1 year actually perform the best, which if you think about it, makes sense. Alpha is a metric where it's identifying assets that are producing a return beyond the market. That typically doesn't happen for long periods of time, so measuring it on a short-term basis actually makes sense. Then in terms of the optimization rate, if you look at it, it's a more short-term strategy. Our results show you'll want to rebalance about bi-weekly or at most monthly. so about every 2 to 4 weeks. Then you can see for historical performance as well, for the most part, alpha performs well in growth years and during times of economic expansion. So for Sharpe's measure, this tends to be historically more what investors on Wall Street like to leverage, and a lot of times what they reference when they're constructing their portfolios. It's not necessarily the choice for all of them, but a lot of the ones that are really into the math side of investing tend to really appreciate Sharpe's measure or Sharpe's ratio as a value identifier. So the results here show you that your average portfolio should include about 8 to 12 stocks. You should optimize it about every 2 to 4 weeks. And if you've gone through finance courses, that's really the message that gets pushed, that you should have about 8 to 12 stocks and optimize them monthly, which just makes sense, which just makes me think that most professors that push that concept are in fact using Sharpe's measure for stock selection, which is entirely possible because it tends to be a favorite of that community. In terms of the historical data, it indicates anywhere from a 5 to 10 year time range being good, with 8 years of history actually being the best. If you look at the returns by year, Sharpe's measure tends to mirror the market. There are certainly years that it's a little different, but for the most part, these stocks are typically the more stable organizations that are out there, and as a result will more so mirror the market performance. Then with Trainer's measure, it's the premium you get for the movement in the market. So Trainer's measure tends to identify stocks that tend to be a little bit riskier because the stock's volatility is what's producing the return. So this is a metric where you want to be aware of the stock's beta to ensure that you don't take on more risk than you need to. For the strategy with Trainer's measure, you really only want a few stocks, similar to alpha. If you're too diversified, it will balance out the volatility associated with your portfolio, and you'll produce a much more moderate return. The return time periods that performed the best were 90 days and 10 years, which really the short-term view in my mind is a little bit safer, but if you have stocks that performed well over 10 years, certainly those could be good selections to consider as well. In terms of how frequently you want to optimize, this one indicates a little more in the 4 to 8 week range. Then for its historical performance, it's quite high throughout most of the time periods. Again, a lot of that has to do with the risk associated with some of these stocks. So if you do go down this route, just be ready for more volatility and pay attention to the beta of the stocks that you're picking. But when you look at the chart over time, you can see that the years that were significantly more volatile, Trainer's measure performed really well in those years. Then one of the best metrics for stock selection is the average. Again, this metric is just taking the average of all the other metric rankings, so it represents stocks that have performed well across all 4 of the other metrics. So these stocks are generally a little bit more stable. You can see in the historical time period that the returns go up as you add more time, up until about 8 years of history where it peaks. So in terms of how many stocks you should include, it recommends either about 12 or potentially a larger grouping. So this strategy might actually work well for some of you that just like to collect stocks over the years and hold on to them. For rebalancing your portfolio, you'll want to review it about once a month. That appears to be best, although anywhere in the 2 to 8 week range could be ideal. Also, if you're using another strategy, leveraging one of the other metrics, coming over and checking out the grade average is just a good point of reference to have to see if the stock has performed well historically in all the different areas. In an attempt to recap what you just saw, I'll just say that depending on the type of year you think we'll have, whether you're predicting a flat market, a growth year, or you think it could be volatile, there are different metrics that tend to work better in those situations, and you should try to take advantage of that. Even more than that, you have to consider the historical return time period that you're using for your data, and even how many assets that you're including in your portfolio. That all is dependent on the strategy that you pick. So ultimately what we're trying to do here is not necessarily define a strategy for you, but educate you so that you are aware that there are different strategies that are out there and how our testing shows to use them for the best outcome. From there, you can pick the assets you want, and then successfully build and manage the portfolio that you've always wanted. Risk aversion is essentially the concept of balancing your portfolio between stocks and bonds in an effort to produce a more stable return. Generally, stocks perform better when the economy is doing well, and bonds generally act as a safety net when times get tough. So their value tends to remain stable or even grow when stocks are going down. Keep in mind that's not always the case, just what's been seen over time, but it can certainly help you maintain a balanced return no matter the market conditions. Your risk aversion score is going to help you understand how much risk you're willing to take on. By determining that, it will help you understand how to break apart your investments into risky and risk-free portfolios. So how do you get your risk aversion score? Well, by taking a risk aversion quiz that can calculate your level of risk aversion and determine how much you should put in your risky and risk-free portfolios. There's a quiz out there at riskaversionquiz.com that's sponsored by Portfolio Degree. It's 8 questions long. Each question has 3 answers. You can either answer buy more, do nothing, or sell. They're all situational based investment questions that present you with a scenario, and if you answer with one of those 3 options. So if you buy more, that's the riskier option. That gives you a score of 3. If you do nothing, that's the intermediate option, so you get a score of 2. And if you sell, that's the lowest risk option, so it gives you a score of 1. The lowest score you can get is an 8 out of 24, which indicates a 33% risky portfolio investment. That would then recommend you put 67% of your portfolio in bonds or risk-free type assets. In this particular example, this individual scored 13, which would indicate that they should put 54% of their portfolio in stocks and 46% in bonds. Using $10,000, for example, this shows you the breakdown between the risky and the risk-free portfolios. Just walking you through this again with a little bit bigger graphic, if you take your risky portfolio that we found in our optimal portfolio example earlier, and we use that here, we take $5,420 and allocate that to the assets that we see here. Then we take the remaining $4,580 for our risk-free portfolio, and we split it into 40% T-bills, 40% bonds, and 20% cash. Now, this risk-free portfolio is just for example. We're not necessarily recommending that this is the best way for you to construct your risk-free portfolio. For that, we are really recommending that you should go and get to know a financial advisor and discuss your options with them. I can assure you they will welcome the conversation. And then here over here on the right is just the total picture of what your portfolio looks like after you've made all your investments. If you'd like to know your risk aversion score, you can go to riskaversionquiz.com and take our free quiz. If you provide your email address, we'll even send you a copy of the results. There's no purchase necessary, and you also do not need to provide us with any of your information, including your email address, in order to see the results. Getting into financial statements, we'll start off with the income statement and the balance sheet. Your income statement and balance sheet are your base financial statements that every publicly traded corporation has to provide. They are important, and understanding how to read them is essential if you're going to be engaged in stock investing. When it comes to the income statement, starting out at the top, you can see your revenue. Sometimes businesses will detail out the different areas of their business that the income is coming from. Then they get into operating costs and expenses. From there, you arrive at your EBIT, or your earnings before interest and taxes. And then you can pull out your interest expense and your taxes in order to get your net income. And then from there, on this particular statement, the corporation also included information about their stock, which just shows you their net income per share, as well as their total number of shares outstanding. When it comes to the balance sheet, this is more about assets, liabilities, and shareholders' equity. So you have your assets, which are things like cash, inventory, property, and equipment, maybe even deferred like tax credits. Then you have your liabilities, which are like your accounts payable, your long-term debt, your lease liabilities, as well as other liabilities like deferred taxes. Then you have your shareholders' equity and the common stock outstanding. That's where you can see the overall equity or deficit that the company is running, and this should help you understand the value that the company is returning to its shareholders or its investors. So when it comes to cash flow valuations are one of the most important things considered on Wall Street when analyzing stocks and making selections. And it really begins with the statement of cash flows, where you see the types of cash ins and outs, from operating activities, from investing activities, as well as from financing activities. That way you get a clear snapshot of how the business operations are performing, as well as a deeper understanding of both the investment and financing arms of the company. Knowing how the company is making its money is important when you're trying to understand what type of company you're actually investing in. Then what you can do with your statement of cash flows is build cash flow valuations. If you break it down to the cash that they have at the end of each time period and look at how that cash is changing over time. You can see in this particular example the three cash flows for 2019, 2020, and 2021. These are just taken right off their cash flow statement. Then what you do as a Wall Street investor is you come up with your predictions for the outlying years using historical returns and projected future growth rates. You also need to factor in the cost of capital, or essentially the interest rate that the company will pay for the time period. And then what you're trying to determine is the net present value of each of those cash flows, and ultimately the final growth expectation for the company, so you can arrive at a net present value for all of their future cash flows, and then that value then becomes divided up by the total number of shares outstanding, and you get your predicted share price. So in a Wall Street investor's mind, a share price moving up or down typically means something in this cash flow model is changing. Then they will then think through, is it the cost of capital? Is it the expected revenue growth rate for the company? Is it their cash position and their future outlook? Like, what is it that's changing that's resulting in the change of the stock price? So those are the typical questions a Wall Street analyst will ask on an earnings call. Those calls are public, and if you call into them, you'll hear analysts ask questions that are primarily related to items driving cash flow valuations. The company will also talk about how their metrics are performing and how certain investments they've made or are making. They'll discuss those types of activities, but most of those calls are oriented towards explaining why their predictions did or did not work out and what they're doing about it. And if you've ever wanted to hear what it's like when a bunch of executives become uncomfortable, attend some of these calls when earnings miss expectations or when the company has some type of regulatory event, and you'll hear folks being asked tough questions and actually being held accountable. So getting a little bit more into the ownership aspect of stocks or companies, if they want to become publicly traded, they will go through what's called a public offering or an initial public offering, an IPO. The same is true if they're already a publicly traded company and they want to issue more shares, they can go through another public offering. Ultimately, what it does is raise capital for the company to help the company grow faster. The company can then make new investments, and that allows all of you as investors to grow and to be able to invest more back in the company and help it grow even faster. So then with dividends come out of your net income. Essentially, when you get to your net income on your income statement, you can go two ways. You can issue a dividend, or you can hold on to the cash and you can reinvest it. Typically, when you issue a dividend, that's indicative of a more stable operation if you're going to guarantee your investors some type of payout. So generally, these are companies that have existed for a longer period of time, that have very stable streams of income, that are able to provide this income and dividend on a regular basis. Ultimately, with the dividend, you just divide it by the number of shares outstanding and you come up with dividends per share. Then depending on the number of shares you own, that will tell you the amount of income you'll get from that dividend. Ultimately, working with dividends as an investor, the thing that you want to keep in mind is dividend yield, which is essentially the dividends per share divided by the share price. Or another way to think about it is that's essentially for every $100 that you're investing, how many dollars are you getting back from a dividend perspective? So a higher dividend yield is going to produce a better return, but that also comes with more risk associated with the company consistently producing that return. As it relates to buybacks, this is when an organization wants to reduce the total number of shares that they have outstanding. Now, it's true, it's a way where you can artificially increase the share price because the overall value of the company is not changing. You're just reducing the total number of shares outstanding. And in order to do that, you need to offer the investors that currently own your stock some type of premium. And many times they'll take it, but then the shares bought back are removed completely from circulation. A lot of corporations over the last 10 to 15 years have been accused of using buybacks as a way to artificially hold up their share price and to offset negative growth rates. There's a certain amount of truth to that, but in reality, there are a variety of reasons why corporations may engage in buybacks that might have nothing to do with their share price. From the same respect, corporations will also engage in stock splits. In addition to buybacks, splits are almost like the reverse of a buyback transaction somewhat, although they're not changing their market value, and it's not another public offering. They're not necessarily issuing more shares that way in this particular example. Instead, what they're doing is they're creating more shares through a split. A lot of times companies will engage in these types of activities when they feel like their share price has grown to an unsustainable level or levels that prevent more mainstream investors or more retail investors from participating. The important thing to understand with splits is that the cash flow valuations of the corporation don't change. Both before and after, they're the same. So if an organization engages in a split, their share price and the quantities of shares in their current investors' accounts simply change. So as an investor, like if you own 10 shares and it's worth $240 or $24 a share, after the split, you still own $240 worth of stock. You just now own 20 shares and they're worth $12 a share. So it doesn't change the value, it just changes the stock price and opens up the stock to more investors. Now, in terms of shareholders' rights and things to be aware of, corporations do have annual meetings as well as quarterly earnings calls. Many parts of annual meetings are open to shareholders. Earnings calls you can listen into, but only typically certain analysts from specific firms are allowed to ask questions. That's generally due to their ownership stake in the company. Now, I'd like to encourage you to listen in on quarterly earnings calls. That way you won't be surprised with different stock movements in the assets that you're investing in, and you'll have a clear understanding of what's going on within those corporations. Now, as a shareholder, you have voting rights that control the board. You elect the board members, and the board members control the corporation's management team. So as retail investors, just know you still have a voice and that you can use with those voting rights. If you go to an organization like a mutual fund or a hedge fund, essentially what they're doing is you're investing in the fund and they're using your money to then go and purchase the stock, and they get the voting rights. So then they use those voting rights to exert, immense control over corporations. Now, the corporation, in relation to votes, will actually make recommendations to you on what they would like to see as an overall result of those votes. But you don't have to follow their guidance. You can go your own way. Typically, though, they're going to make recommendations that are going to be in the best interest of the corporation. And generally, you want to listen to them because they know their business better than others. But again, it's your voting rights and it's up to you. The SEC is the Securities and Exchange Commission. They're the regulatory body that oversees the buying, selling, and trading of securities. So essentially think of them as sort of the pseudo market police. They exist not only in the United States, they exist in a variety of forms around the world. So just be aware that these are the people that are going to be monitoring what you're doing. If you ever find yourself in a place where they reach out to you, just work with them. They are just trying to get to the bottom of something. And certainly if you're ever doing something that's attracting their attention, maybe think twice before continuing. All right, getting into retirement planning. So probably one of the most confused topics is the traditional versus Roth when it comes to things like your IRA or 401k. And there's not really a straightforward answer for which is the better overall. It really depends on market conditions and certain assumptions that you make about taxes. If you're making contributions pre-tax, you're assuming that the taxes you're paying when you take that out are going to be less than what you'd pay today. And if you believe taxes are going to be less in the future, then you want to go more that traditional path. If you would rather use after-tax money to invest to avoid taxes on your earnings in the future, then you'd prefer a Roth path. In this example, let's say at 40 years old, you get a one-time $200,000 bonus from work as a kickback on a new product that you helped develop. I mean, how wonderful would that be? So using that as a baseline and assuming you're contributing 100% to your retirement plan, the question is, would you rather pay taxes now based on your income tax rate or defer those taxes until you get to retirement and are able to withdraw the money? So in the Roth, you'll have an upfront tax bill of $66,000 if you have a 33% tax rate. So you're starting out at $134,000 versus a traditional plan where your tax bill initially is zero and you're starting out with $200,000. Assuming you accumulate the returns for 20 years, no additional contributions, and then withdraw a reoccurring amount for 30 years, like an annuity, in the traditional plan, you'll certainly end up with more in your retirement account. But as you go to withdraw the money, you'll be hit with taxes. And in the Roth plan, you can still get hit with taxes, but it's not as likely. So either way, your after-tax take-home is about the same. So it's just really a matter of if you want to be worth more or if you want to pay less in taxes. And then as it relates to capital gains tax, for most assets that are held onto for more than 1 year, it can be anywhere from 0, 15, or 20% tax depending on the asset type and the income that you've made. So most investors in retirement try to withdraw less than the cap for 0. But if you're also taking Social Security payments into consideration, you really got to think through that, because if you withdraw too much, it can impact your payments and you might end up receiving less Social Security or even having to pay back some of that if you're not careful. Also keep in mind that those rates are just for holdings for more than 1 year. So you're holding onto your assets for more than 1 year. For assets that you held onto for less than 1 year, typically you're subject to your current income tax rate, which can actually be considerably higher. Getting into mutual funds and hedge funds, what exactly are they? Well, in reality, they're all funds. The word hedge came about later on. Hedging is just a strategy that most of them employ. So really, it's just a group of people that are pooling their assets together in order to exert more control over their investments. That way they can control certain incomes a little more and make sure they're getting the returns that they want for their investments. Typically what you're doing when you're pooling your money together is you're buying shares in a fund, and then it's the fund that's using your money to go and invest in what they want. So doing so transfers the voting rights that would come from you owning the stock to the funds that are managing that actual investment. So that gives them the power. And if you believe in your fund manager, then perhaps that's exactly what you want to do. And the vast majority of folks really aren't equipped to handle managing their portfolio, which is why these funds have been so successful over the years. So understand that most of the money behind them belongs to everyday folks, like teachers, nurses, tradespeople. These big funds get a bad rap because they're managed by these big firms on Wall Street, but they do exist in order to help out a lot of average, everyday, ordinary people that just don't have time for stock investing. So it's up to you whether or not you want to purchase their products. Most of you have employer-sponsored 401ks that are likely forcing you into certain mutual fund products. They aren't typically bad products, but you do have to pay attention to their performance and make sure you're putting your money in funds that are actually providing stable returns over time. It's supposed to be a lot more stable, but really a lot of these are a lot like stock investing, and you really just have to be careful which funds you choose and where you put your money, because losses are definitely still possible. Okay, taking a step back for more of an economic perspective, but also we want to take you through some definitions for markets, industries, and sectors. And getting into all three of these, they can be a reference to both macro and micro concepts, meaning like global concepts, but also things that are in your local markets or local communities. So typically these are applied on a macro scale in general in the world of finance, but more generally, they're referred to when speaking about, they're used more so when speaking about a particular industry or sector that a corporation is participating in. So, markets are generally a reference to like an economy or a group of economies or, a trading place, such as, like the United States, Europe, or things like the G7 or the BRICS nations. Getting into sectors and industries, we'll go through some actual examples here in a moment. But with sectors, it's really like the area of the economy that a company is participating in, like consumer durables, energy, finance, maybe technology. And that differs from the industry, where an industry is more about the product that you're competing with, like advertising or hotels or semiconductors, restaurants, things of that nature. So expanding on markets, here are some examples for a general reference. For our purposes in this training, we just want you to understand that a market can be an economy or a group of economies. It can even be different trading markets as well. Here are some examples of industries. To expand on how complex industries can get, I used to work in the travel industry, or that's what we would always call it, the travel industry. But in reality, the travel industry comprises a variety of different complementary industries. Industries like airlines, hotels, restaurants, even advertising, and whether you realize it or not, things like credit cards. Those are mainly the result of the travel industry. That's why they were originally called traveler's cards. And that was all part of the travel industry as a way to help sort of expedite transactions and not worry as much about currency exchange when business travelers are moving about the world. So you can even expand on that further and talk about that there's an entire EDP, electronic digital payment industry, to support all those transactions. And then you can go even a step further to now talk about travel insurance as well. So you can see how saying something like the travel industry, while it sounds very simple, it can actually be a mask for something much more complex. And using industries for filters can be helpful for you when you're trying to find similar investments to consider and trying to find which investments are the right ones for you. So moving into sectors, here are some more examples. As you can see, they are a little bit more general and related to the area of the economy that the company's participated in. Getting into some of the basic economics. In our full course, we touch on a few concepts, but it's mostly just as a way to help you understand some things that will help you manage your portfolio a little better. The concept we want to share now is the invisible hand of the market. Essentially, the invisible hand of the market implies that markets will self-regulate, which is an interesting concept that you might not agree with. Some people might want to know, what does that really even mean for a market to self-regulate? So basically what they're implying is that if you make a bad product, the consumers are going to figure that out and they're going to stop buying it. And if nobody buys your product, you won't have sales and you'll be forced out of business. So that's sort of the invisible hand of the market. It can be a good thing or it can be a bad thing depending on what's going on in the market. But what I like about it is what it's implying is that it's saying consumers make rational decisions and provide competitive markets through freedom of choice, which is really what we're hoping to help you unlock when it comes to stock investing is the ability to have more freedom of choice. So we view this concept fairly favorably. Now, there are a lot of different ways that you can leverage these concepts. Another way that you could view the invisible hand from is that each and every one of you out there are doing what you think is best and pushing for the changes that you think are necessary. And it's only by pushing for change that you're actually going to begin to see it. And, don't forget, you can use your investments to have a voice, especially as a shareholder. It can be a very loud voice. You paid for your seat at the table, so don't forget to use it. All right, so let's get started. So some basics that you need to know before you get started, like with actually trading and making buying and selling some stocks out there. The first thing that you want to do is establish a relationship with an investment advisor. You want to establish relationships as you embark on this path, and you're going to want to find somebody to throw some ideas off of that can help you facilitate some of these transactions. They can also act as a voice of reason, and at times they can provide counterpoints to your ideas. We also recognize that the market can be a very dynamic place, and it's always good to have an advisor to help, to have someone that monitors that stuff more closely so they can let you know when things are not looking right or not going well. When you first begin investing, start with what you know and things that you're naturally interested in. You're going to be interested in investments, and if you're interested in your investments, you're going to want to follow them. You'll also be proud of the fact that you're an owner in those corporations. So it'll be an experience that you'll want to share, and as you become more comfortable with these concepts, you'll push yourself and expand on your research. So pretty soon, you'll begin to think a little differently, and you'll start to incorporate stocks from other industries and other sectors in your portfolio, just as a result of really trying to figure out what works for you. But just remember, don't feel bad if you're jumping from one company to another as you try to find the firms that you want to hold on to. Their relationship with you is just financial, so you really don't need to overthink it. In terms of buying and selling, there are some basics that you need to understand when you actually go to transact with stocks. There's a bid price and an ask price. The bid price is the price you are willing to pay to purchase one share of the stock. So if you think about it like an auction, you're essentially making a bid to purchase the stock. It doesn't guarantee that you'll get it at that price, and of course, you can just do a market order where the brokerage firm will just buy the stock at whatever price it's available at. And then if you're going to do a limit order, that's the fourth one down. That's where you can specify a price that you're willing to buy or sell at, and the platform will only transact at that price. So those orders usually last for the trading day. And getting back to the ask price, it's essentially the price that someone is willing to accept to part with a share of the stock. So that's the price that's currently out in the market that's being demanded for the shares. So at the end of the day, market orders generally work pretty well. And unless you're working in large quantities, you aren't going to necessarily move your profit all that much at the end of the day by sticking with a limit order over a market order. When it comes to growth versus dividend stocks, the growth stock is relying solely on the growth of the stock price in order to provide a return. And so these companies are expected to maximize their cash flows in an effort to beat analyst valuations and to outperform price expectations. Dividend stocks are stocks that are paying a guaranteed return to their investor. So generally, there's a declared dividend and a dividend growth rate that will allow you to see how the company views its future outlook. Most dividend-paying stocks are more well-established firms. However, some companies will participate in one-time and special dividends. Generally, when someone refers to a dividend-paying stock, they're referring to a stock that pays out a dividend on a regular basis, either 2 or 4 times a year, typically. If you're new to investing, sticking with dividend stocks can be a good way to try and help minimize price fluctuations. Sometimes a lot of the risk associated with your portfolio is going to be associated with the price fluctuations of growth stocks, and by focusing on dividend stocks, that will help bring some price stability to your portfolio. Keep in mind, as they pay out their dividends, they're also paying out an investment, so the price will lose a little right after they do that, but that's why you're receiving the dividend payment, is to offset that loss in the price. So, or that's what's reflected in the loss of the price is the dividend payment. So depending on your brokerage account, you can have your dividends automatically reinvested. Every broker I've ever met has always encouraged me to do that, and you should do that. But if you need the cash, you can always just receive the dividend as cash and spend it as you see fit. And then even then, at that point, if you still want to invest, you can always do that the next time you rebalance your portfolio. Now, the investment world is a fairly complicated place. There are a lot of folks out there with different types of certifications. I just wanted to provide you with a list of some of the more common ones. There are a lot of certifications that are out there and we don't include, but here are some of the main ones to be aware of. Before working with any investment professional, you should always ask them about their background, like their education and any certifications that they have. The more that they do have, the more you'll know they're committed to investments and doing a great job for you. Now, in regards to choosing a brokerage firm, there's a variety of them that are out there. They have a lot of different trading platforms. Some are more oriented towards different types of trading for people with certain types of needs. You really don't need to have too many interactions in order to trade with these institutions. And you might also find that some of the names that you were initially excited about turn out to be the ones that you learn to stay away from. That said, everyone's experience is a little different, so don't set expectations for yourself based on someone else's experience. A lot of times you'll find people that work for really big firms that are phenomenal individuals that work really hard. So don't discount a big firm as some type of bad thing. And then at the same time, you might find people at smaller firms that will sign fiduciary responsibilities, but then think that they can get away with things that, in your opinion, aren't best for you. So, just keep in mind it can go both ways, and really do your homework before choosing the platform that you leverage for your trades. One more time, I want to put this in front of you just to reiterate what we're coaching here. Hopefully at this point you've got an idea of what strategies you want to use, and after this video we'd encourage you to start finding some assets that you think will suit you. And as you're adding assets to your portfolio, don't be afraid to add a few extra just to see how everything reacts and what kind of grades you do get. From there, you can narrow down your choices to the number that you'd like to invest in, and then find your optimal portfolio so you know how to balance everything out. And then don't forget to apply risk aversion as well and distribute your total investments between risky and risk-free portfolios. Then depending on your strategy, you'll want to check back at least every 2 weeks and assess if you want to change anything. And again, whenever you go to make any changes, whether that be buying more or selling off one of the stocks that you have, or maybe it's just to rebalance to a new optimal portfolio using the same stocks, whatever your motivation, you always want to weigh your decisions with any potential tax implications. And that's one of the main reasons why it's always a good idea to consult with a financial professional before making any moves. So keep that in mind that, while we are helping to show you how to manage everything, we're constantly encouraging you to work with financial professionals before making any investments or before making any changes to your current portfolio. Now, hopefully these lessons can act like a compass and guide you on your investment journey. Keep in mind that this program is here to educate you, not tell you what to invest in. That's for you to decide, and for each of you, the answer to that question will be different. So I'll just leave you with this last piece of advice: to never stop learning, never quit on your investments, and no matter where you're at in your life, you always have the power to improve your situation and to make it better. And in the hope that it motivates you, here's one last quote from Thomas Edison that's always inspired me. There's a way to do it better. Find it. Okay, now if you want to get access to more, first off, I just want to say thank you for listening this far. I really appreciate you being here and taking the time to join the Portfolio Degree Power Hour. At this point, if you're interested in our full program, we certainly hope you consider signing up. We feel that we've priced it fairly competitively for what you get in return, and we've tried to get to a price point where the commitment is fairly minimal on your end. So as you can see here, we have sort of two different paths that you can take. We offer more of a self-paced path with digital content or a live virtual training environment as well. You do have, obviously you're in the Portfolio Power Hour right now. We also offer a virtual version of that where we host it live with up to 50 people included. And then of course we offer our full training courses as well to get access to all those training materials. And then we do have the discount code here, POWER10, for you for completing the Power Hour. So that'll give you 10% off of all the course offerings. And then again, if you'd like to join a all-day virtual environment to go through, all the different courses, it's a live seminar. The prices there are available as well, and we'll touch on a little bit more what's in that day here in just a moment. So as a reminder, here's what's in our full course and the different lessons that we offer. You can see that it's a lot of the same topics we just covered in the Power Hour, but obviously we cover them in much more detail and give further examples and really help you develop a deeper understanding of these concepts. And in terms of the technology supporting Portfolio Degree program, we have the portfoliodegree.com, where we host all of our training videos. We have riskaversionquiz.com, where we can help you understand your risk aversion score and your allocations between stocks and bonds. And then we have our website, Portfolio Examiner, which at this time is still under construction. That's going to be our site where you can go and get your portfolio graded, practice building a portfolio, and search for assets that you want to invest in. You'll also be able to customize everything so that it's in line with your strategy. Now that'll be a great place to go and compare assets and build portfolios with different combinations and see how they're predicted to work out. And if you're someone that you prefer that more personal coaching and you don't want to just sit through another video, like I mentioned earlier, we do offer live virtual training days. These days are set up as a full day virtual seminar where we host the different courses throughout the day and take different points in time to build portfolios and talk about deploying different strategies. This is an opportunity to get fully immersed in the content, to learn in a group setting, and to ask questions directly to a Portfolio Degree coach. These courses do cost a little more and take a full day, but if you're looking for an in-depth learning experience, this is the path for you. Until next time, I'm your portfolio coach, Matt Franklin. Thank you for being here, and have a great day.